The biggest real estate crash in history isn't just coming, it's already begun. And Warren Buffett saw it first. A staggering $2.7 trillion in commercial real estate debt is about to hit a wall, and the aftermath will reshape the entire property market for a generation. Hey everyone, in today's video, we're diving deep into what could be the most significant real estate market correction of our lifetime. This isn't speculation or fearful thinking. This is about cold, hard numbers and market fundamentals that are already in motion. We're going to break down exactly why this matters to every investor and homeowner watching right now, and more importantly, how to position yourself for what's coming. Let's start with what Warren Buffett knows that most people don't. The Oracle of Omaha has been quietly making moves that speak volumes, and if you understand market psychology, these moves are screaming that something big is coming. He's recently dumped significant portions of his Bank of America stock, and it's not just any routine portfolio rebalancing. When the world's most successful investor starts distancing himself from banking institutions, especially ones as stable as Bank of America, it's time to pay very close attention. But here's what's even more telling, and frankly, unprecedented. Buffett now holds more Treasury bills than the federal government itself. This is a man who made his fortune buying productive businesses and holding them forever. Yet he's now stockpiling what many consider the safest possible investment. Think about the significance of this move. Buffett, known for his famous quote about being fearful when others are greedy and greedy when others are fearful, is essentially building the largest financial fortress in history. He's preparing for something big, and we're going to break down exactly what that something is. Let's dive into the numbers that have Buffett and other market veterans deeply concerned. We're facing an unprecedented $2.7 trillion in commercial real estate debt that's coming due within the next 20 months. To put this number in perspective, this is larger than the entire GDP of most countries. But the size alone isn't what makes this situation so dangerous. It's the timing and the interest rate environment these loans are maturing into. Most of this debt was originated when interest rates were between 2 and 3%. This was during the era of what we now know was historically cheap money. Today, these loans need to be refinanced at around 7%. This isn't just a minor adjustment, it's a fundamental reshape of the entire commercial real estate market's economics. To understand the magnitude of this problem, let's walk through a real-world example that'll make these numbers crystal clear. Imagine a $100 million commercial property. This could be a hotel in Manhattan, an office building in Chicago, or an apartment complex in Houston. When this property was originally financed at 3.5%, the annual interest payment was $3.5 million. The property might have been generating $5 million in net operating income, making this a perfectly suitable investment with healthy cash flow margins. Now, fast forward to today. At 7% interest, that same loan now requires $7 million in annual interest payments alone. But here's the critical part that many people are missing. The property's income hasn't doubled just because interest rates did. It's still only generating $5 million in income. This means the property is now underwater by $2 million annually, and that's before we even consider principal payments or any other operating expenses. This is the mathematical reality that thousands of property owners are about to face. This brings us to one of the most important metrics in commercial real estate, the debt coverage ratio, DCR. This isn't just some abstract financial concept. It's the fundamental measure banks use to determine if they can lend on a property. Typically, banks require a DCR of 1.25, meaning the property needs to generate 25% more income than its debt payments. This isn't arbitrary, it's a buffer that protects both the lender and the borrower from normal market fluctuations. Let's apply this to our example. In the original loan scenario, $3.5 million in interest required $5 million in income, giving us a DCR of 1.43. Healthy and sustainable. But look at what happens with the new interest rate. $7 million in interest would require $8.75 million in income to maintain an acceptable DCR. This is where the mathematical impossibility becomes clear. The property simply cannot support this level of debt under current market conditions. Here's where it gets fascinating for investors watching this video, and where the real opportunity lies hidden within this crisis. Using the 80% rule of thumb for sustainable debt service, a property generating $5 million in NOI can only support about $4 million in annual debt payments. This isn't opinion. This is mathematical reality based on current market conditions. Working backward at current rates, this means the maximum supportable loan amount drops to approximately $48.4 million. Take a moment to let that sink in. A property that was once valued at $100 million, based on actual income and current interest rates, can now only support roughly half that value in debt. We're looking at a potential value decrease of over 50%. And this isn't a worst-case scenario. This is based on current market rates and traditional lending standards. The implications of this are staggering when you consider that this scenario is about to play out across thousands of commercial properties nationwide. We're not talking about a gradual adjustment. We're talking about a fundamental repricing of the entire commercial real estate market. This is exactly the kind of environment where generational wealth can be either created or destroyed, depending on which side of the transaction you're on. While 70% of single-family homes have mortgages under 4% and 30% are owned free and clear, the commercial real estate crisis will nonetheless send ripples through the broader economy that affect homeowners. Local banks holding commercial mortgages may face severe pressure, leading to tighter lending standards across all sectors. Property tax revenues could decline significantly, affecting local services and school funding that homeowners depend on. We're also likely to see job losses in real estate, construction, and related industries that could impact local economies and housing markets. However, there is a silver lining for homeowners. This isn't 2008. The residential market today has fundamentally different characteristics that provide some insulation from commercial market turbulence. Most existing homeowners are locked into low rates, which provides stability in their monthly payments. Housing supply remains constrained in most areas, with the exception of the South, helping to support home values. Perhaps most importantly, lending standards have been much stricter since the last crisis, meaning the residential market rests on a much more solid foundation. Now, let's address a question that's probably on many viewers' minds. How will this commercial real estate crisis affect residential housing? The connection between commercial and residential real estate is more complex and intertwined than many people realize, and understanding these relationships is crucial for both homeowners and investors. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. First, let's understand the banking connection. Many regional and local banks that provide residential mortgages are the same institutions heavily invested in commercial real estate. When these banks face stress from their commercial portfolios, they typically respond by tightening lending standards across all their loan products, including residential mortgages. This means potential home buyers might face stricter requirements for down payments, higher credit score thresholds, and more rigorous income verification processes. The employment impact creates another critical connection. Commercial real estate difficulties often lead to job losses in construction, property management, real estate services, and related industries. In many metropolitan areas, these sectors represent a significant portion of the local workforce. When these workers face income uncertainty or job losses, it can trigger a cascade of effects in the residential market, from increased mortgage defaults to reduced home buying activity. Property values present another important linkage. When commercial properties experience significant value declines, it can affect the overall perception of real estate values in an area. This psychological effect can influence residential market sentiment, particularly in mixed-use neighborhoods or areas with significant commercial presence. Additionally, large-scale commercial property value declines can impact local government tax revenues, potentially leading to reduced services or increased residential property taxes to make up the shortfall. However, it's crucial to understand that the residential market has several unique characteristics that provide some insulation from commercial market troubles. The widespread prevalence of 30-year fixed-rate mortgages at historically low rates means most current homeowners have very stable housing payments. This stability helps prevent the kind of forced selling we might see in the commercial sector, with the exception of home insurance prices rising. Furthermore, the persistent housing shortage in many markets provides a fundamental support for residential values that doesn't exist in the commercial sector. Yet certain segments of the housing market may face more direct impacts. Residential properties in urban cores, particularly luxury condominiums in areas with struggling office markets, might see more significant price pressure. The reduced foot traffic and potential urban exodus could affect both property values and rental rates in these areas. First-time home buyers might actually find opportunities in this environment. As banks tighten lending standards for larger commercial projects, some may shift their focus to residential lending, particularly for conforming loans that can be sold to government-sponsored enterprises. This could create pockets of opportunity for well-qualified residential buyers, even as the overall lending environment becomes more conservative. For current homeowners, the key consideration should be the stability of their local job market and the portion of that market dependent on commercial real estate. Areas with diverse employment bases and less reliance on real estate and construction sectors will likely see more stable housing markets. Conversely, markets with high exposure to commercial real estate employment might experience more significant housing market impacts. For investors looking to capitalize on these opportunities, it's crucial to focus first and foremost on cash flow fundamentals. This means calculating maximum supportable debt based on actual property income, not historical precedent. The 80% rule will be essential in determining realistic purchase prices in this new environment. Additionally, building relationships with local banks who will need to dispose of distressed assets could provide early access to deals. When evaluating opportunities, investors should target markets with strong underlying economics. This means focusing on areas with demonstrated population growth, diverse employment bases that can weather economic uncertainty, and strong rental demand that can support stable occupancy rates. Perhaps most importantly, investors need to be ready with capital when opportunities arise. This means building cash reserves now while also establishing lending relationships before they're needed. For those new to commercial real estate, considering partnerships with experienced operators could provide both access to deals and valuable operational expertise. The correction won't happen overnight, which is actually good news for prepared investors. We're looking at a rolling crisis as loans mature over the next 20 months, creating multiple windows of opportunity. The key numbers to watch here are staggering. Over 27,000 commercial loans will need refinancing during this period. Based on our earlier calculations, average value drops could range from 30 to 50%, depending on the property type and location. What makes this situation particularly interesting is that regional banks hold approximately 68% of commercial real estate loans. These institutions don't have the same flexibility as large national banks to hold problematic assets on their books for extended periods. This creates a perfect storm where motivated sellers meet market reality, often leading to exactly the kind of price discoveries that create exceptional buying opportunities. Office properties face particularly intense pressure due to the continued evolution of work-from-home trends. It's not just about higher interest rates, it's about a fundamental shift in how businesses use space. However, this pressure creates opportunities for creative investors who can reimagine and repurpose these assets for modern use cases. The coming months will separate informed investors from the crowd. Those who understand these dynamics and position themselves appropriately could see generational wealth building opportunities. We're not just talking about small gains, we're talking about the potential for transformative returns that could set up families for generations. As we move into this period of market transformation, success will depend on focusing on actual income rather than historical values, calculating sustainable debt levels at current rates, and building strong relationships with local banks and brokers. Having capital ready to deploy when opportunities arise will be critical, as the best deals often move quickly in distressed markets. The real estate market is entering uncharted territory. While the challenges are significant, they create opportunities for those who are prepared. What we're witnessing isn't just a market cycle, it's a fundamental reshaping of the commercial real estate landscape. Subscribe to our channel and hit the notification bell to stay informed as this situation develops. We'll be providing regular updates and detailed analysis to help you navigate what's coming. Thanks for watching, and watch this one as well.